What do you expect for the month of September? We've got an ECB meeting coming up. We've got the Fed meeting coming up. We've got a 2-year note that breached 3.5.
Yeah, we talked a little bit about the 2-year last night on Fast Money, and I do think that that's particularly important because I think what it means is that multiples are not going to be a support for this market. And I've been talking about this for a while, but I still think that we need to see sort of a quote-unquote proper bear market that's driven by a deceleration in earnings growth because we haven't really seen a re-rating in 2023 expectations, at least to the magnitude that I think we're going to see. So what that means is the 2-year continues to press higher. The 2-year never really bought the Fed pivot narrative. And if you look at the correlation between interest rates and PEs, it's quite high. Higher interest rates, lower PEs. And we've seen a gap open up there, right? PEs expanded over the past couple of months as the 2-year continued to press higher. You guys just mentioned it, highest level since 2007. So I think as that gap does compress, PEs come down, and then you see a deceleration in earnings growth. That's going to be the biggest headwind for the market between now and, say, the end of the year.
The thing that we haven't really heard too much of, and I think what many investors had expected to hear, Ann, during earnings season, was a slowdown in corporate spend. And we got sort of a glimmer of that more recently, and particularly from Seagate the other morning when they said, you know, we're seeing caution. HP, we heard it from their conference call that they're seeing caution among corporate buyers. We're seeing this as we enter a period which is going to be volatile. And then you add to that whole mix, that whole brew, a lockdown in China of a very populous city that makes up 1.7% of Chinese GDP. Do you feel like these are things that finally the markets have to factor in, and so we are headed for a period of lower PEs?
I think we are definitely looking at a period of lower Ps and also a period to look at other valuation metrics, lower EV to EBITDA multiples, which is really a close proxy for free cash flow. And a lot of these companies trading just on PE, particularly in the tech space, are not free cash flow generative. And when we've got an environment with slower corporate spending, slower consumer spending, I think the market's going to be looking to pick and choose a lot more aggressively those companies with clear execution plans and better value when it comes to some of the more cash flow intensive or reflective metrics as well.
How, I don't want to use the word scary, but I'm going to go ahead and use it. How scary, Jeff, is this lockdown of Chengdu? I mean, the fact that we thought that we were through the worst of it, that companies started talking about improvements in supply chains during the earnings season, and now we've got this lockdown here. It really sort of underscores the notion that at any moment, a manufacturing hub could be shut down.
Yeah, I think that's exactly right. And why did the market rally in June and July? It was because of this Fed pivot narrative as inflation started to peak. And if you start to put doubt in central bank minds that inflation might still be a problem because of some of these supply chain issues, it's only going to embolden them to continue to raise rates, at least in my opinion. And I think also what you have is a peaking inflation narrative, maybe a little bit more in question now, but then you also have a labor market that's still overheating, for lack of a better terms. And the Fed continues to come out and tell us what they're going to do. They want the Fed funds rate above neutral, and there are plenty of ways to measure that. But at a bare minimum, you're talking about a neutral rate of somewhere around 3%. I think given what we're seeing in China, given the fact that they want to be very sure that they have inflation under control, you're probably talking about a 3.75, 4% Fed funds rate by the time this is all said and done. And it probably stays there for a while. And I think that that's enough to challenge multiples as we go forward.
And where do you find safety in this sort of market if we are headed for lower PEs?
Well, safety is hard to come by, but definitely trying to look at least for a little bit less volatility. And so, Melissa, a couple of the areas I'm looking at are slightly more insulated from some of these supply chain pressures, a little bit more domestically focused. Disney being one of them. I know Becky mentioned that earlier, but what they're doing now in terms of integrating more closely their content, their commerce, and their merchandising capabilities with the balance sheet to continue to invest in growth and streaming, I find very attractive. And that idea that there's a core business funding investment in new growth for the long term, even through a recession, is also part of the thesis underpinning why I'm spending time looking at PayPal and also General Motors. You've got these legacy big fintech, big autos, but with the cash and the wherewithal to invest, in this case, in new fintech trends and into EV with real tailwinds in those sectors, I think, coming into next year. So it's this hybrid safety at the core business, but investment into new growth levers.